today we are going to introduce you to the income statement, also known as the statement of comprehensive net income.
Income statement is the financial statement that calculates your profit. The income statement used to be called a trading and profit and loss account in the past. That's because the top part of it that calculates gross profit is the trading account section. Trading meaning you're selling and you're buying. And then the bottom part was your profit and loss section. That is where you added any other income besides sales, because we deal with sales revenue in the trading account section, but there may be other income that the business earns. For example, discounts received, interest received, rent received, commissions received, service fees received. So you will add that to your gross profit, and then you have your less expenses. And these are just examples because there are many expenses. So you have to identify the expense in your question for the business from the information, and you would less it here. And this is the entire income statement. Now it can seem like a lot of information, but if you break it up into parts, which is what we are going to attempt to do, you'd realize that it is not as difficult as it may appear when you just look at it.
So once again, it calculates the profit or the loss made by the business for the period, the end of the accounting period. Usually it's 1 year. And it is prepared by transferring information from the nominal accounts like sales, purchases, income, expenses accounts. And note once again that opening and closing inventory. So I said once again, because here we have it in your books, opening and closing inventory also included. And here we have it in our notes. So the income statement includes nominal accounts, which are the income or revenue, and expense accounts, and the opening and closing inventory. No assets. Well, opening and closing inventory can be seen as assets, but no other asset, only revenue and expenses, nominal accounts. Sales is income, purchases, expenses. So you see, that is how it is. So as we said before, expenses and revenue amounts are transferred to the income statement at the end of an accounting period. And this is how it is done. Remember our accounting cycle, we have our journal first. So you enter in the general journal at the end of the period, and for expense accounts, you're transferring, and to transfer means to take out something. So that means you're going to be decreasing the amount. So here is the only time, or the main time, only at the end of a period, which we credit the expense account. Remember, during the period for all transactions where we pay expense, expense is a debit, only debit, 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 debit. At the end of the period, when we are transferring the expense account out of the expense account into the income statement, that means that we are going to do the opposite of the debit, which is for increase, and we're going to decrease by crediting. So this is why we have credit expense account. And where are we taking it? To the income statement. Why do we have income statement as a debit? Before, believe it or not, the income statement also looked like a T account. So they had a debit side and they had a credit side. Now we do it the vertical format, but the journal still states it as such. Just remember what you do for the expense account. You are crediting because you are decreasing or taking out the amount. So the income statement will be the debit. All right, and you see it here. This should look familiar to you. It should look familiar to you because this is when you close off an account. Remember, you transfer to income statement, and we just put income statement. So this is the journal entry, and you are familiar with the account. The revenue or income, however, revenue income is usually credit. So because we are now going to take it out of the revenue account to transfer it into the income statement, what are we going to do? The opposite of credit will be debit. So we are going to debit the revenue and therefore credit the income statement. They rarely ever ask you for the journal, but I have started to see recently where just for like probably 2 marks or so, they are starting to ask for it. So just be familiar with it. Remember that you are decreasing the nominal accounts, so you will do the opposite in this case for it. Expenses that are usually a debit, you're going to credit and debit the income statement instead. And the revenue or income that is usually a credit, you're going to debit instead to take it out and put it into the income statement on the credit side. Okay. So now that we have dealt with the journal entries and the T accounts, now we are going to go to the financial statement. Now, before the financial statement, you guys remember what was in between there, the trial balance, right? So just remember, we just finished that, and the amount that was transferred to the income statement for the revenue and the expenses, remember, that is the amount that goes on the trial balance. Expenses will be the debit side as normal, because it's still a debit for expenses, and the income or revenue would be the credit side. Then now we are going to take that information and we are going to do the income statement. So the income statement calculates the profit or the loss in the income statement. I just repeated. All right, so profit is calculated in 2 stages. First thing that we calculate is your gross profit, which the very, very simple formula is sales revenue or sales minus cost of sales. It was known long ago as cost of goods sold. So if you see cost of goods sold when you are doing past papers, like the really old ones, it means the same as the cost of sales, which is what we are going to be referring to it, because currently that is what we refer to it as. So the first stage is the gross profit, sales revenue minus cost of sales. And the second stage would be to find your net profit. Your net profit is always a gross profit minus something else. And in this case, what they're going to be minusing would be your net expenses, or basically this is what happens. Your gross profit, you may have other revenue like rent received and discount received and commissions received. Those are not the main revenue of a business. When a business operates, the main revenue is the sales revenue. So the other things that you happen to also get, like rent received, that will be added to your gross profit. In other words, the first stage only deals with the business revenue and then the cost of sales. The net profit, you're going to add whatever extra revenue there is, if there is any, and then you are going to minus your expenses. Okay? So the stage that we are going to deal with first is the trading section. So the trading section is the one that calculates your gross profit. And remember what we just showed you, what was the very, very, very simple calculation? Net sales minus cost of sales equals gross profit. Or we had it the other way, gross profit is equal to net sales minus cost of sales. We'll go a little bit more into detail a little later on what net sales means. Why net in front of it? Net, remember, every time you see net in front of something, is just sales minus something else. Net purchases will be purchases minus something. Okay? So sales is the revenue earned from selling goods. And the cost of sales, or cost of goods sold as it was previously referred to, is the cost associated with acquiring or getting, that is what it means, acquiring or getting the goods that were sold. So basically this is the sales and the money you make from selling it. That means whatever the price of it is, you sell it for, multiply by the number that you sell, that would be your sales revenue. The cost of sales is that same sales, but the value that we are going to be using is not the value that we get. It is going to be the value that was the cost of those sales. How much did we have to spend on that inventory to be able to acquire it or get it? And of course, you would see one of the costs is like purchases. I mean, you can't sell something you don't have. So you had to spend money to buy or purchase the inventory so that you can resell it. So those are the two items, the two terms, very important. Just want to make a note here now, guys. Income statement, extremely important. Every single business that we are going to be doing in CSEC POA has an income statement. Please, it is better for you to really practice and learn it off now so that it is easier as we keep on adding stuff. Okay, then. So like all the formats, you start with the name of the business, and then you have, this is your heading, income statement for the period ending and whatever the date is. For example, 31st of December, 2021. Period is usually, you usually insert the exact period. So if it's a year, you're going to put a year. So for the year ending. Some people have said ended, so it can be both of them, right? They don't really kick up a fuss as much with this. Period, be specific. So if it's a year, it's a year. If it's 6 months, it's 6 months ending. If it is 3 months, it is 3 months ending. All right. And then if the cost of sales is given, meaning they give you the figure already, so they gave you sales, or net sales, have the asterisk because we're going to explain that after, but it is your net sales, last column, and they gave you the cost of sales, less cost of sales. Remember, that's the formula, net sales less cost of sales. You put it in the last column. Remember how we identify when we are subtracting or lessing something, or if it's a negative figure, you put brackets. So that is why the brackets are there. Will give you gross profit, right? And you must put it in this way. Net sales, last column, the amount. You must put the less cost of sales, and the amount they gave you in brackets is equal to gross profit, and you just minus the two figures and you get your answer. I have it in red. Please don't put it in red in the People NM exam. Or I should say your exam. Do not write in red ink at all. This is just for visual purposes so that you can just see it really clear. It is emphasized for you. So once again, when cost of sales is given, this would be your format. Very, very, very simple in order to calculate your gross profit. And this is an example. Your net sales is 25,000. Your cost of sales given is 18,700. You put it in brackets, and 25,000 less the 18,700 will give you 6,300 as your gross profit. And you must have it written here. Remember, accounting language, we are telling people what things are. So if you just have 6,300 and you don't have what it is, that is very useless information. It is only useful if you tell them it is gross profit. Nice. Examiners and CSEC and, in general, in real life, actually, cost of sales figure is not given to you, right? So yes, in an exam, they may give it to you and you might simply have to go net sales less cost of sales, like you just saw there, equal gross profits. Seeing it here. But more than likely, and definitely in real life, you don't know what the figure is. It is not given to you. That means that we have to actually calculate it. And this is how we will calculate it. The format, so you would have net sales, you would have less cost of sales, but this here is how we are going to calculate cost of sales. I just want you to notice something. When we are doing the actual format, you would have less here. I put this in capital letters and I underlined just to emphasize this is not like previously where it was less cost of sales and an amount. No, this time we actually have to do calculations. So this is a heading. There is no amount to go here because we now have to go and calculate that amount. First item to calculate, opening inventory. What is opening inventory? The amount of inventory you have at the beginning of the period. Just picture it in your business. You have a warehouse. How much inventory do you have in your warehouse at the beginning of the period, at the start of the period? That will go in the middle column. Why not the last column? Because we have to do calculations. So we're going to use these other two columns to do our calculations. And then when we finally get our cost of sales, we're going to put it in the last column. So we start with opening inventory. You put the amount in the middle column. You find that in your trial balance if they give you a list of balances. You add net purchases. Net, once again, purchases. Net purchases will mean that we might have to do some calculations, like deduct or add something to purchases. But for now, what is most important? Purchases. So add your purchases. Think about it. You have inventory in your warehouse, but it may not be enough because you want to sell as much as possible so that you can earn enough revenue and then profits. So you may have to, you do a stock check and you will note that you need to purchase more inventory. When you purchase that inventory, you're going to add it to the already available stock in the warehouse, the opening inventory, to get what you now have in your warehouse, which is called cost of goods available for sale. Okay, reason why I have this like that, I don't want you all to focus yet on it. When you are doing your format, you will write it in, but for now, I want you to focus on the really important items. Opening inventory. Start with opening inventory, middle column. Add net purchases, middle column, the net purchases. You draw a line every time you have to do a calculation. You add the two, and what do you get? Your figure in the middle column, which is your cost of goods available for sale. Last thing that you do, you have opening inventory. You start with that. What you think you're going to end with? Closing inventory. And you are lessing the closing inventory. So that means it goes in the middle column. You must have it in brackets. closing inventory is usually written underneath your trial balance. So you would see that underneath it there. And you draw a line. Why? Because you're going to do a calculation. And that is your cost of sales, which can now go into your last column. So let's go through really, really quickly again. You start with your opening inventory, which is how much you have at the beginning of a period. So let's just say that represents that, right, for visuals. Then you add your net purchases. That is how much you purchase. You add it. So now you have this amount of inventory. And this amount of inventory, this sum here, is called your cost of goods available for sale, meaning that is how much inventory you have that you can now sell. Good, as simple as that. So it's nothing complicated about it. And then you end with less closing inventory. So what is closing inventory? How much inventory you have at the end of a period. Why would you only have these two remaining in your warehouse? Because the others were sold, right? They were sold for revenue, net sales. But remember the value of it that I said? When you sell it for the price that you have set for it. And the price is usually to make a profit, right? But what was the actual cost of that inventory? You notice all these figures, or you may not have noticed, so I'm going to emphasize it now. This value is a cost value. Purchases is definitely a cost value. How much did you pay for the inventory? And the closing inventory is the cost value. Cost of sales is therefore a cost value. So you saw when we sold it, yes, we sold it for a value, a price that is higher than the cost, but the amount we just calculated is your cost value. This is why you're lessing closing inventory. When you less closing inventory from the opening inventory net purchases, which was your cost available for sale, and then you sold goods, so you only had this left. When you less it from up there, this is what remains, which is the amount that was sold. And this value is your cost value, which is what we wanted to calculate. Yep. So this is the format. You can just look at it. And this is what you simply going to remember at first. Okay, there are other things that we're going to add to it after, but for now, the very simplest form is this. So an example, they gave us opening inventory. They did not give us cost of sales. So therefore, we have to calculate it. We start with opening inventory, middle column, from your trial balance or list of balances. Add your net purchases. Your net purchases is the amount after any deductions. They may just give it to you. Add it. You draw your line to show that there's a calculation, 19,600. Less closing inventory. You get it at the bottom of the list of balances or your trial balance. Put it in brackets. In this case, it's 9,300. You would have drawn a line to show that there's a calculation, 19,600 minus 9,300. You get your cost of sales figure, which is placed in the last column, which is 10,300. Once you just learn and memorize these steps, you're gonna be good. So let's do this one. Here you see, they gave you opening inventory, net purchases. Here they put the closing inventory up here because they just balancing, it's just balances, it's not a trial balance, and your sales. So we just gave you the information there. After you have, well, we're not doing the format, we're doing the calculation, but yes, I'm gonna put it in a form like the, what you call it, like the format. We're not dealing with sales yet. What I'm asking for is to calculate cost of sales. So we will just put opening inventory. You could have put the heading there, cost of sales, but what do you start with? Opening inventory. Look for your opening inventory, $40,000. What comes after that? Remember, add your purchases. So add net purchases, 260,000. You draw your line, you add them up, and you get 300,000. And then what's the last thing you do? Less closing inventory. They gave you 45,000 in brackets because we are minusing, subtracting, less. You draw a line to show there's a calculation, and your cost of sales is $255,000. Calculate gross profit. Remember what gross profit is? Simply, it is your sales minus your cost of sales. So it will be net sales, which is this, minus your cost of sales. So 540,000 minus what we just calculated, 255,000, and that is 285,000 as your gross profit. Once again, just one step at a time. So this one is in your books. Page number may be incorrect. It may be from an old one. So we're doing it here. We have calculate cost of sales. So what do you start with? Opening inventory. They didn't say opening inventory, but you have the date there. 1st of January. That's the beginning of a period. Opening inventory. 12,900. You add your purchases, 34,500. Add it up, you get 47,400, which will be your cost of goods available for sale. Less your closing inventory. Look, you see it's underneath here in this case. Set closing inventory, there's the date to confirm, 14,000. In brackets. Draw your line for calculation. Cost of sales is therefore 33,400. So that was in your books. You will do the others with the correct pages, of course. And I just did this one for you as an example. So to calculate your gross profit, once again, it will be net sales minus cost of sales. So your net sales figure, they gave it to you, 53,400 minus what we just calculated there, which will give you 20,000 as your gross profit. Okay, cool. So here is your format in terms of the income statement. And this is it for a very simple income statement, the trading section, which is the section on top, the first section where we calculate our gross profit. And so you would see that you have your sales, and then in between here is where you calculate your gross profit. Sorry, your cost of sales. It's where you calculate your cost of sales, and then you get your gross profit. So these are the assignments that you will do in your books. This is the format. So you have a format here, and you can use this format as an example, or, no, not or, and do not use this for every single question, please. You could use it for the first one, or you can just start one time trying to memorize it. If you get it wrong, erase it. Do this in pencil and erase it, okay? The next part of it, we did a very, very, very simple, and that is great. So in another lesson, what we are going to do, we will do the other parts of it, the parts that are added in. Remember, we talked about net sales and net purchases. That will therefore include what we call our returns, which is our return inwards and our return outwards, and then carriage inwards, only carriage inwards, right? So the next lesson will be about adding these things.